Thomas Jefferson once warned that banking institutions could be more dangerous than armies, and that spending today to be paid by future generations is just swindling on a grand scale. Fast forward to today, and the term fiscal dominance is making headlines. So, what does it mean? Simply put, fiscal dominance happens when government debt and spending start to influence how central banks, like the Federal Reserve, set interest rates. Instead of fighting inflation, the Fed may be forced to keep rates low, just to help the government afford its own debt. And this isn't just theory, it affects your money. It can shake up debt markets, weaken the US dollar, and push stocks in unpredictable directions. With rising deficits, a pressured dollar, and political tension around rates, fiscal dominance is no longer just an economic term. It's a potential risk to your portfolio. Stay informed, because in this market, knowledge is an investment. Gold just did something historic. It smashed through $3,500 an ounce for the first time ever, jumping 30% this year while the S&P 500 is down 10%. Once known as the fear trade, a safe haven in uncertain times, gold is now the ultimate greed trade. Investors aren't just buying it for protection, they're chasing performance. From Wall Street to Asia, the gold rush is global. Chinese ETFs and futures are hitting record highs, and US options traders are just as bullish. But here's the catch. Gold is now trading 20% above its 120-day moving average. Historically, that's where things start to cool off, or correct. Still, this isn't just a hype story. As we mentioned before, there are 4 major long-term forces driving demand, and they're still in play. Gold is hot, but whether it's a smart bet or a crowded trade, that's for you to decide. Microsoft just hit pause on some of its AI data center builds, and now Amazon may be tapping the brakes too. According to new reports, Amazon Web Services is quietly pulling back from certain co-location deals, especially in overseas markets. While Amazon insists this is just routine capacity management, Wall Street is picking up on something deeper. Analysts are increasingly talking about a potential digestion phase, where hyperscalers like Microsoft, Amazon, and Google slow down after years of rapid, almost unchecked expansion in cloud and AI infrastructure. This isn't a total reversal, but it could signal a shift in momentum. The AI boom, especially around generative models, pushed data center demand and chipmaker stocks into overdrive. Companies have been racing to secure everything from land and power to GPUs and real estate. But now, the tone is changing. Leasing activity is slowing. Early-stage build-outs are being delayed, and fewer new agreements are being signed. The implications are big. Cloud and AI infrastructure plays, especially data center REITs, server OEMs, and semiconductor giants like NVIDIA and AMD, could face short-term pressure. Some investors are already trimming positions or holding off, waiting for clearer signals. Of course, this doesn't mean the AI opportunity is fading. Long-term, demand is still expected to be massive. But in the near term, markets are adjusting to the idea that hyperscale growth won't be linear. It may come in waves, with periods of rapid expansion followed by strategic pauses. And right now, we may be entering one of those pauses. Keep an eye on leasing trends, earnings commentary, and future CapEx guidance, because the next move by the hyperscalers could set the tone for the entire AI infrastructure sector. Tesla just missed Q1 earnings estimates, and the numbers raise serious concerns about the company's core business. Automotive revenue dropped 20% year over year. Total revenue fell 9%. That's Tesla's steepest revenue decline in over a decade. So, what happened? Lower vehicle prices, factory retooling for the updated Model Y, and rising global political risks all hit hard, pressuring both margins and investor sentiment. But here's the kicker. Tesla only stayed profitable thanks to regulatory credits. Without them, the company would have lost money on car sales. That's a major red flag. Meanwhile, Elon Musk's recent focus on politics and crypto, like Doge, has distracted from Tesla's execution. Although he just announced he's stepping back from Doge to refocus on Tesla, some investors are calling it too little, too late. Rivals, especially in China and the emerging robotaxi space, are gaining ground fast. And with tariff uncertainty looming, Tesla's global position is under more pressure than ever. There was one bright spot: energy revenue. That segment surged 67% year over year, showing strong momentum. But it's still a small piece of the business. For now, Tesla bulls betting on an AI breakthrough or energy pivot may need more patience. The core auto business is clearly slipping. And unless Tesla can quickly reset its strategy and focus, Wall Street's faith could continue to erode. The road ahead looks rocky. Tariffs between the US and China may finally be reaching a breaking point. Treasury Secretary Bessent made headlines this week, saying the current tariff structure, 145% on Chinese goods and 125% on US exports, is simply unsustainable. That's a big signal. It suggests the Trump administration may be ready to step back from the high-stakes trade war that ES been weighing on global markets. Investors took notice fast. The S&P 500 jumped 1.67% on the news, even though no formal negotiations have started. Just the hint of de-escalation was enough to lift sentiment. So what's at stake? A rollback in tariffs could ease recession fears, improve trade flow, and relieve pressure on corporate margins. Exporters, manufacturers, and multinationals, especially those with exposure to Asia, could all benefit. But let's be clear, the road to resolution is anything but certain. The IMF and S&P Global are already warning that existing tariffs are dragging down global growth and pushing up debt. And at home, political and legal opposition to current trade policy is growing louder. So while markets are hopeful, this could go either way. The bottom line, if the tariff tide turns, it could be a tailwind for global equities. But for now, investors should watch for signals, not promises. When we talk about government debt and deficits, the usual questions come up. Is this sustainable? How will we ever pay it off? Fair questions. But there's a bigger issue lurking beneath the surface. It's called fiscal dominance, and it could reshape how markets work. So what is fiscal dominance? In simple terms, it's when a government's debt and spending become so large, they start to limit what the central bank can do. In other words, the central bank loses its independence, especially when it comes to controlling inflation and interest rates. Let's back up. Under monetary dominance, the central bank is in control. It sets interest rates, fights inflation, and keeps the economy balanced, without worrying too much about government budgets. But under fiscal dominance, that flips. Massive deficits and high debt levels force the central bank to act differently. Even if inflation rises, the central bank might not raise rates like it normally would, because doing so would make government borrowing more expensive. In short, the government's need to finance its debt starts driving monetary policy. This is a problem. Why? Because it weakens the central bank's ability to fight inflation, distorts bond markets, and increases risk for investors. Markets become more volatile, and traditional playbooks stop working. And with U.S. deficits rising fast and political pressure building, many analysts believe we're heading straight into a period of fiscal dominance. If you're an investor, this isn't just economic theory. It affects bond yields, equity valuations, and the strength of the dollar. Bottom line, keep an eye on deficits, not just because of what we owe, but because of how they might reshape the entire financial system. How fiscal dominance impacts the economy. Without getting too nerdy about it. Let's be honest, fiscal dominance sounds like one of those dry policy wonk phrases that puts most people to sleep. But don't zone out just yet, because what it really means could affect your job, your investments, your mortgage rate, and even the value of your savings. So, what are we talking about here? In simple terms, fiscal dominance happens when a government's spending and debt gets so big that it starts to control or limit what the central bank can do. Normally, it's the other way around. The central bank sets interest rates, fights inflation, and keeps the economy stable. But under fiscal dominance, that script flips. And today, we're going to walk through 4 big ways that this shift can impact the economy without diving too deep into the weeds. Inflation starts to heat up. Let's start with the obvious one: inflation. Under normal conditions, central banks keep inflation in check by adjusting interest rates. If prices rise too fast, they raise rates. If the economy slows, they lower them. But under fiscal dominance, that power weakens. Why? Because if the government is spending a ton, running big deficits, and the central bank feels pressured to keep rates low so the government can afford its borrowing, then inflation becomes harder to control. Worse, if the central bank starts buying government debt directly, basically printing money to cover spending, it fuels inflation even faster. That's how we go from controlled inflation to runaway prices that hit everyone at the grocery store, at the pump, and in their rent. Debt spirals and yields rise. Next up, debt. When governments spend more than they bring in, they borrow a lot. And with every new deficit, that debt pile grows. Now, as debt rises, so do the interest payments. It is like maxing out a credit card and then only paying the interest each month, except on a trillion-dollar scale. Here is the twist. If inflation rises and the central bank doesn't raise rates aggressively, investors start to worry. They demand higher yields to hold that debt because it's riskier. So now we have more debt, higher interest costs, and a central bank stuck in neutral. That creates a self-reinforcing loop. Rising deficits push up yields, which increase borrowing costs, which lead to even bigger deficits. You can see where this is going. Currency confidence wavers. The third impact? Loss of confidence in the currency. Investors and global markets are always watching what central banks do. If they sense the central bank isn't in control, that it's just a tool of government spending, they start to get nervous. Swelling deficits and a hesitant central bank make people question the safety of a country's bonds and its currency. And when confidence slips, the consequences are fast. Your currency weakens, imports get more expensive, capital starts to flee, and investors look elsewhere. It's not just a theoretical problem, it hits real-world wallets. Crowding out the private sector. Finally, let's talk about crowding out. Governments fund deficits by selling bonds, but when they issue too many bonds, they can suck up the capital that would have gone into the private sector. That means businesses, especially small and mid-sized ones, find it harder to borrow. Investment slows. Innovation dries up. Economic growth takes a hit. Think of it as a competition for money, and the government is winning, but at the economy's expense. A few historical flashbacks. If this all sounds dramatic, just know, this has happened before. Post-World War II, many countries leaned on central banks to finance massive war debts. Fiscal dominance was essentially the norm. In the 1980s, Latin American economies faced crippling inflation and debt meltdowns fueled by unchecked government borrowing. During the 1997 Asian financial crisis, poor fiscal control and currency instability led to widespread economic pain. And recently, some argue that pandemic-era stimulus spending, combined with accommodative central banks, may have pushed us right back toward fiscal dominance in developed economies. So where are we now? Today, many G20 countries are running significant budget deficits, but the United States stands out. Why? Because of its massive role in the global economy and the US dollar's position as the world's reserve currency. That gives the US some breathing room, but not a blank check. The bottom line? If deficits keep growing and central banks feel they can't raise rates when they should, we're walking into a world where inflation, debt, and market risks collide. That's fiscal dominance in action, and it's not just some academic idea. It's a real risk investors, policymakers, and everyday citizens need to understand. Because once the central bank loses control, getting it back can be painfully expensive. So what's the takeaway? Fiscal dominance isn't just an economic buzzword, it's a warning sign. When government debt gets too big and central banks can't act freely, it reshapes everything, from inflation and interest rates to markets and currencies. We're not sounding the alarm just yet, but the pressure is building. And for investors, policymakers, and anyone thinking about the future of the economy, this is a trend worth watching closely. Thanks for sticking with us. If you found this helpful, give it a like, share it with someone who still thinks deficits don't matter, and subscribe for more breakdowns, minus the jargon. Until next time, stay informed, stay sharp.